Back for part 5. Nick Fenton here with TickerTank.com, and continuing our 7-part series. In part 5, I'm going to discuss my personal allocation methods for this particular strategy. I'm doing so, I've switched over to paper money for obvious reasons. I'm going to be showing some account balance stuff and buying power effects and things like that. So I didn't want to do that in my regular account. Switched over to paper money. And we'll just go ahead and do it through paper money. A couple things I want to mention here in paper money. If you use paper money on a regular basis, I think first of all, I think it's much more effective to use a regular account, even if you're just doing a one contract or one lot in a spread, versus doing 20, 30, 40, 50 lots in a paper money account. You're going to get way more out of it from a psychological and emotional reaction perspective, and you're going to learn a lot quicker when you're using real capital versus paper money. Also, there's a few things you're limited on. You aren't capable of doing in the paper money account. One of which is, like, if we're in UNG here and we go down to today's option statistics, you can't. It doesn't show the IV statistics. So you need to be in a live account to get the current IV percentile. If you don't have the script built in, the custom script that I have for UNG here, or just any stock that I pull up, well, it's not even going to show up here. So yeah, you're just kind of out of luck if you're SOL if you don't have the live live trading account. You can't see IV percentile. And another really big bummer is if you want to scan for using study filters so that you can incorporate IV percentile into your scan. You see here, study filters only allow scans based on predefined or custom studies. Study filters are only available in live trading platforms, so you aren't going to be able to do that in a paper money account. Those are just two side notes unrelated to this particular video. Just thought I'd mention them though. So let's get back to the topic at hand. So what I've done here is I've built the UNG Strangle we've been talking about from an example perspective throughout this video series. We're looking at the selling 1 February UNG. This is the February 2014 options we're looking at here with 58 days left until expiration, I believe, at the moment. And we'll be selling the 18 put, selling the 26 call for a credit of 55. That means our max gain on this trade is $55. Max gain is achieved in between 18 and 26. And our break evens roughly 26.55 and 17.45. Anything below 17.45, we start losing money. Anything above 26.55, we start losing money. So we've got a 78%, we're almost 79% probability of staying within our break-even to break-even range. Very strong, high theoretical probability of success strategy. And I mentioned early, I believe in part 1, that this is my favorite strategy. I've also done a video on how I go about deploying my capital depending on different market volatility environments. So in a low volatility environment, I'll deploy about 60% of my net liquidity. In a high market, implied volatility market environment, I'll go up to about 80% of my net liquidity. I like to leave a little bit of cushion for buying power effect adjustments in these naked strategies because the majority of my portfolio is comprised of naked option strategies. That's just the style I like. I prefer selling premium and doing so in a high theoretical probability of success perspective. But I do also practice strategic diversity, so I make sure that I don't have too much in any one given particular strategy. So even though short strangles is my favorite strategy, I don't want a portfolio of just short strangles because I've tried that and I got burned bad. So what I generally like to do is I like to allocate 3 to 5% of my intended net liquidity. And so let's say we're in a low implied volatility market right now. If you look at a chart, we pull up the VIX. We've got a VIX down here around 12. Yeah, it's sitting here at 1171 today. Looks like I should go ahead and position bullish on the VIX. So we're definitely in that low environment, so I'd want to do about 60% capital deployment. Here, the net liquidity in this paper money account is $126,342. So I would take about 60% of that. So let's just go over here. We'll say 126,000. And of course you can do this in your head, but I'm just doing it this way for the sake of visually showing you everything. So about $75,600 is what I intend to have deployed. And I like to allocate 3 to 5% per short strangle. And generally, I like to have somewhere around 20-30% of this number allocated specifically towards short strangles. I like to have a good large amount of short strangles going at all times. And it's just a great strategy, so I like to have a lot of it in my portfolio, but I don't want to overdo it. So with that in mind, 3 to 5% per underlying, with a total of 20 to 30% of my intended capital deployment number. So we calculated the 60% capital deployment number based on the 126,000 net liquidity number right here at the top. So we're taking 60% of that. And for this particular trade, we would want to do 3 to 5% allocation based on this 75,600 number. So how do we determine, this has theoretical unlimited losses essentially. So how do you determine how to allocate this? You might be asking yourself. And the answer to that question is you go down here to trade. We're here on the Analyze tab and Risk Profile. And you right-click on the trade and hit Create Duplicate Order. Right now we've got it set to 1, just because we were just analyzing it. But now we're trying to figure out how many of these we actually want to sell. Once you get into this Create Duplicate Order, you want to hit Confirm and Send, and it's going to give you some information here. It's going to tell you the break even on the stock, 17.45, 26.55. It's going to tell you max profit is 55. Max loss is theoretically infinite, which, but from a probability perspective, you're not going to lose an infinite amount of money. Cost of the trade, it shows you after commissions are taken into consideration, and these are my paper money commissions, so it doesn't reflect my actual commissions. But the next one here is the one we want to pay attention to. Buying power effect. It is $96.19. So essentially that is the broker saying we're going to adjust your net liquidity down by $96 per strangle that you sell. So essentially you're locking up around $100 to sell one of these strangles. So for every strangle you sell, you're locking up $96 in buying power. So essentially you're risking $96 to make max profit of $55 if you let it go to expiration, which I never do. So with that in mind, this is the number that I utilize to determine my portfolio allocation. So I said, I generally like to do 3 to 5% per underlying. Let's just assume 5%. So all we would do is go back to this number here and multiply that by 5%, and it gets $3,780. And then we can divide that by the $96 buying power effect, and that tells us we can do about 39 contracts. So you may err to the downside, do 35, or err to the upside and do 40. Let's just do 35 for the sake of keeping things just a little bit below 5% portfolio allocation, not going outside our means. So create duplicate order once again. That's going to show you, if you go to confirm and send, your buying power effect has been modified to $3,385, which represents 5% of that $76,900 number. So that's the process that I go through for short strangles. It's a fairly easy process once you have it formulated, but from the outside looking in, if you're a beginner and you're just learning how to do the short strangle strategy and wondering how the hell you're supposed to allocate these types of things, that's how I go about doing it. That's my thought process when I'm doing these types of trades. So in this case, I would do about 35 based on these paper money numbers, and based on my capital deployment methods, and based on my personal preference on portfolio allocation. Now, I do need to note that I'm not an advisor. I'm just here educating you, sharing exactly what I do with this type of strategy and all the strategies that I talk about. So by no means is this advisory. This is just me sharing some information with you about how I view things, how I go about doing this particular strategy, how I go about allocating. I'm not telling you it's the right way or the only way. I'm just showing you how I do it. You can take this information, do with it what you please, but hopefully it clears the air for you a little bit, and at least points you in the right direction to figuring out exactly how you want to go about allocating. So I'll see you back in part 6. We're going to be talking about some exit criteria. So how I go about exiting this particular strategy, where I look to take profits. See you then.